It's not often that we sit here in the middle of the year and have a significant change to the outlook that we struck at the beginning of the year. But really, a lot has changed, and there's a lot that the Fed is doing that have led us to think differently about what might happen in the next 6 months. When we struck these probabilities at the beginning of the year, we had the bull case at a 20% probability, but I think we're ready to sort of move that higher now. And then let's talk about how the probabilities have changed. And then what I'm always interested in people ask, well, how long can this persist? Like the bull case, is this just till the end of the year? Is it into 2022? How do we think about that?
Yeah. So starting off with the bull case, the probability as we sit here today with 5 months of data, it's probably around 50% probability. And just reiterating one more time for the viewers what the bull case is. So the bull case consists broadly of all of this money that was created last year, a record amount of money created. This year, it finally has someplace to go because the vaccination effort is better than expected and the economy reopens. And at the same time, policymakers like the Fed and like Congress look at this better than expected economic growth because of all this pent up money that is now being unleashed on the reopening economy. And they are worried about doing anything to disrupt it. So they don't even think about taking the punch bowl away. The Fed does not raise interest rates. The Fed continues buying assets. Congress continues to debate more fiscal spending. And what you get is this environment where the economy is supercharged, full of money, 1.21 gigawatts worth, and you get very strong GDP growth and very strong appreciation in asset prices. We've proved out, hopefully, why we think this is a much higher probability scenario than we did to start the year. The thing that we're debating the most is if you look at the bull case and the bear case, the first half of them basically identical. So what differentiates the bull case from the bear case is in the bear case, during the second half of the year, policymakers respond to this better than expected economic growth by making a policy mistake, and they withdraw stimulus too early. So from the Fed side, that looks like an aggressive tapering of asset purchases, potentially hiking interest rates far too soon. In terms of Congress, that looks like not focusing on fiscal spending, but focusing far more on actually making sure tax hikes go through. And that would be a big policy mistake. And if you combine that with any type of a reemergence of lockdowns, that could be a recipe for disaster.
If you just look at how the predictions we made on the bull case, a lot of these things have already happened, are in process of happening. 3.5% inflation rate, seems like what the Fed wants, but the 2% 10-year Treasury yield. A lot of people think that if that happens, or if we breach 2%, that's the end. The markets are going to crash. Explain to people why that is just a false narrative.
Yeah. So the phenomenon we're talking about, why interest rates need to stay low, is because of TINA. There is no alternative. So what we're looking at here is the difference between earnings yields on equities and the 10-year Treasury yield. Because where are you going to go, right? The money has to go somewhere. So as long as stocks on an earnings yield basis look attractive relative to 10-year treasuries, then the money is going to go into equities. So, why 2% isn't something that needs to be feared is earnings yields this year are going to rise dramatically because we're going to get a huge recovery in earnings, corporate earnings. Consensus is that S&P 500 earnings should expand by about 25% this year. So that's going to send earnings yields on the S&P 500 up towards 5%. So, a 10-year Treasury yield at 2%, that's still a very healthy equity risk premium. The difference there, the earnings yield minus the 10-year Treasury, is still very healthy. Mm-hmm. We would have to see an environment where Treasury yields rise rapidly in an environment where corporate earnings are falling, meaning earnings yields are going down, and all of a sudden, there is an alternative. Bond yields actually look attractive relative to earnings yields, which may be deteriorating. That happens in a policy mistake environment where we go back into some type of a lockdown related to COVID. That's what happens in the bear case scenario.
Yeah. So last question, maybe to comment on. At some point, GDP growth will slow. I mean, we're accelerating now. We expect it to accelerate for a while, but at some point it will slow. And if we do agree that inflation will be transitory, we'll see that actually start to decelerate as well. What does that look like? When could that happen? How does that translate into market outcomes?
Yeah. Well, so personal savings as a percentage of GDP have averaged 20%. So there you go, right? If we get back down to 5, that means 15% of GDP. That means consumers, just by spending down their savings, can add another 15% towards GDP. If they do that over 3 years, that's 5% per year. That's far better than any stretch we saw post-global financial crisis.
Right.
And then it's really just a question of how quickly do they spend it down. And then also, as this is happening and demand is exceeding expectations, businesses are going to have to invest. They're going to have to build inventories. All that goes to GDP as well, inventory builds. So, it's really how quickly can we spend all these savings? If they do it all this year, then the growth outlook going forward will be far less attractive. But if it's spread out over a few years, this could be a pretty sustained above average growth environment.
Yeah.